Good evening, ladies and gentlemen. This is CORRECTIVE Trading Frank. It's approximately 8:13 p.m. on December 17, 2018. This is a strategic market update webinar. The weekly webinar session will be recorded, uploaded to the CORRECTIVE Trading YouTube channel for viewing by all members and anyone out there with the internet connection at their own time. Full disclosure, this is purely for financial education and not for any solicitation or advice. All members, and to pass on the word on our CORRECTIVE Trading Instagram channel, friends, colleagues, family, whoever's out there, please click follow. Member counts grow, a follower count is growing nicely. Some strategic insights in some of the highlights of the trades that we do for promotional purposes.
Learning you have a condition.
Are
moving to a new city.
I have no idea what that's coming from.
Caring for your parents.
That is the joy of having Google Ads. I apologize. I muted that sudden video that sound that came through. Anyway, we are building on an Instagram account, which is primarily for promotional purposes to spread the word out there. We also have Facebook and LinkedIn presence. Please, all of you, feel free to follow as a gesture of support for CORRECTIVE Trading. Doesn't cost you a penny. It is extremely informative, not real-time posts, obviously, but end of the evening, I tend to put out some of the highlights of what we do. On that note, let us begin. We are going through a major correction. This is a rolling correction. It is not that the market just opens up and keeps on falling all day long. We had some tremendous intraday reversals. The first part of the day, trades were highlighted. Things were up 30-40% from the alert posted just intraday and from the previous Friday when we bought. There were selected trades that went up very, very nicely, and some of them still stayed up very nice, was up more than 100% on those options, which was new beverage, NBEV. There were multiple other trades which also earlier on in the day and even, well, a good portion of the day stayed up, and even after hours was up, is up right now on major buyback announcement, and that is Boeing. So, key is that this is a complete capitulation, panic correction that we are going through for different reasons. So let me just explain in very simple terms what they are. First and foremost, this is pure panic. This is momentum selling at its finest, at its full glory. Mom and pop investors, traders, including many of you, are just abandoning the market, period. Everybody's, like we say in New York, shit scared of the market and do not want to touch anything that has to do with stocks. So, momentum begets momentum, selling begets selling, and it just is a cascade. Technicals that I keep on showing and adjusting as accordingly as the markets fall, and of course the intraday fluctuations included. You can see a premium example of that right here on the E-minis that I keep on showing every day. Remember, during an emotional capitulation in the market, which is a kind of a rolling correction, technicals can only show you the posts of the guidelines or the markers on a highway, which way you're going. It cannot predict immediately where it's going to land up at the end of the day. Accordingly, all day long, every 15 minutes, every 30 minutes, if not on a faster interval, I go ahead and post these highlights, which are called roadmaps. You can active traders can trade this very effectively for both long and short gains. So that's what we do. So it's up to you what you can do or need to do. As I've always said, and it's not me saying that, that's a fact, 90% of trading is an emotional game. So, in order to control your emotions, you have to rely on charts. Now, most people, and I'm, past half the century, I'm an old man with a lot of energy. I know most people cannot control their emotions. It's a fact. Whether they be our political leaders on all fronts, whether they be traders, whether they be investors, majority do not have a handle on their emotions. They either get very sad, they get very happy. Well, nobody's really happy. Nobody ever gets really happy, because even when the markets were very happy on a one-way ride up, people weren't happy because they weren't in there. So what happens is there is an emotional dysfunctionality that is omnipresent in both bull and bear markets. We are in a short-term bear with some heavy swings on the upside. We're not in a long-term bear. We are in a short-term bear or a corrective phase. So emotions are rampant. Fear is absolutely 110% grip the average investor, and of course the retail trader, and institutional hedge funds too are getting blasted. So all I can do to keep my sanity, and hopefully help you keep your sanity, is to provide some very precise tactical roadmaps which will show you how far we can fall, how far we can rise, and you have to manage your trades accordingly. The volatility that we are seeing in the market over the past couple of weeks and over the past couple of months and pretty much all through 2018 is extremely enhanced. And these are the reasons why. We have a situation which has to do with the liquidity in the market. And quantitative tightening, which is the opposite of quantitative easing. And I want you all to Google quantitative tightening and learn it yourself what it means. I posted some very important articles on that matter. In other words, the Federal Reserve is draining money instead of pushing money into the market. Remember when the Fed was doing quantitative easing a couple of years ago? The Fed got criticized by every single so-called Monday morning quarterback as to what they were doing wrong. Now they are quantitative tightening in the form of raising rates, in the form of winding down their balance sheet. And please Google them and read it, because I don't have time here to explain all those economic explanations right now. I want to keep this within an hour or less, this particular session. So when you have quantitative tightening, there's a lack of liquidity. It affects global markets. It raises the cost of borrowing. And there is a tightening and shrinkage in the overall market. That's number one. Number two, we have the China trade war still ongoing. China has done a lot of things, and President Trump's economic team, trade negotiating team, in my opinion, has done a fantastic job of getting the Chinese to loosen restrictions on imports, on tariffs, on opening up their markets more. And remember, these are big stuff. They don't happen in one day. But the fact that they're moving along those lines is a big thing. But the market doesn't always agree with that, because they're not seeing the results of it. They want a final resolution. Well, it ain't that easy. So that's the other thing that's hanging over the market. First and foremost, in very simple terms, what happened in the market is a very emotional reaction to everything. Good news has been thrown out. Bad news has been amplified. You hear the bears coming out of the woodwork. You have Ron Paul saying this is a 1929 depression. You got the guys who are short the market talking their books saying that there's going to be economic recession next year. In my opinion, and again, who am I? But still, I have my opinion, right? It's called the freedom of speech. I think it's all hogwash. It is. We are not in a recession. Housing prices have moderated. Consumer confidence is still high. Retail numbers were very strong when they were released last week. But there is a fear that if the China deal is not resolved, if the Fed keeps on a strong tightening bias, which they have repeatedly, by the way, said through different Fed speakers that they're looking to moderate the pace of interest rates hike, but the market doesn't want to listen. That if the Fed doesn't basically, keep on getting more dovish, then the U.S., then it's going to be absolutely crazy for the U.S. economy. I kind of agree with that, But I don't think the Fed's that stupid. I don't think their business is to throw the U.S. economy into a complete tailspin. But that fear is very much there. Yet, if you at the same time, the irony is that if you look at the overall Treasury yields, whether it be in the 2-year, the 5-year, the 10-year, the 30-year, they're all falling. They're all falling. All the yields are falling. Just a month or two ago, if you remember, in very simple terms, they were all screaming and shouting, "Oh my God, rates are going through the roof. Borrowing costs are going to go nuts. Nobody's going to be affording a mortgage, all blah, 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 blah." Now that rates are significantly down, and I had shown some charts on that too, that we were going to fall below 2.9% on the 10-year, which is a benchmark for a lot of lending rates, consumer lending rates. Now they're talking the opposite. Oh my God, yields are falling, so we're going to go into a recession. Look, I've been around the block for a long time, okay? Not like 20, 30 years, but I think I'm a very astute student of the market. Can't determine every day what's going to happen in between everything. And even though I am showing you through my charts that where you need to buy, where you need to sell. So anybody with half a brain, honestly speaking, no offense meant to anybody, anyone, I repeat, with half a brain can trade these charts. They can trade these levels. Anybody who's looking for a absolutely perfect straight line up and straight line down is living in a fool's paradise and will be eaten alive by the algorithmic high-frequency trading boxes and the stock market. So instead of blaming the world, the market, me, the charts, blame yourself for not doing what is needed. It doesn't mean you have to be green at P&L at the end of the day, but you can minimize your losses and can make some substantial gains intraday and overnight on multiple trades. End of story. I don't want to be here, being your daddy and telling you what you need to do is right. Because I have one son, I just want to be his daddy. How about that? His dad. Okay? I don't want to be anyone else's dad. So saying all that, the other things that's happening, some critical things, is of course a Wednesday FOMC meeting, which is going to give us an indication of what the Fed wants to do. I'm not going to sit here and tell you what I think the Fed should do because what does my opinion matter? I personally think the Fed should raise rates quarter of a percentage point and be extremely dovish and give a signal that they're not looking to raise rates going to further because of all the economic weakness globally and in the U.S. slowdown that they're starting to see. And I think that'll be great. Market will dip initially, and then they're going to rise like a monster. If the Fed doesn't raise rates at all, then that in a way it can be interpreted as, because the market's a wild beast, okay? It's not as simple as you guys think. I know most of you are great people, but most of you, when it comes to the market, are very simple human beings. You always like to see black and white. It is not black and white. It is gray. Lots of gray. Okay? Just like a combat zone. It's not all like fighting in the sunlight. It's a lot of fighting in the dark. So if the Fed basically says they're not going to raise rates at all, the markets will initially rally and then sell like a mofo, like we say in New York. Why? Because that will send a signal that the U.S. economy is in deep, deep, deep trouble, which it's not. And that the Fed is so scared they're going to lower rates. I mean, not lower rates. I mean, not raise rates this coming Wednesday. So the markets will initially rise, and then it's going to crash again. But we know where it's going to crash to. It's either going to go into the levels, every level that I've shown. 2440, 2430, we're going to go through some of the charts, and you can basically trade according. We short intraday, we make anywhere from 100 to 300% on that money. And the ones who are sitting around saying, oh, well, he's got a couple of SPY calls out there too. Sure I do. But I manage them accordingly. Sometimes I get out of them, as you should, and sometimes I keep them, buy them low cheaper, and at the same time intraday and overnight like we did from Friday, keep those SPY puts. What gives? Is this rocket science, guys? You can be on both sides of the trade. Knowing that the levels we're going to fall to, at that point, you can cover your short, i.e. the SPY puts, sell your SPY puts, and roll that profit into the SPY calls. Because one way or the other, the market is going to bounce. It always does. It bounced this morning. First part of the day. So, like I said, use your own brains. Use my chart. Utilize your brains. Move your hands. Put some money in the market. Go long and short. Make some money. Waiting for some perfect moment? Well, there are certain perfect moments, which for the first time I said it today, and I'm going to show it on the charts, where it would be a absolutely phenomenal buy, technically speaking. We're not there yet. Will we get there? Maybe, maybe not. Why? Because what I said, if everybody's watching, a watch pot never boils. If everybody's looking at the same level, the market never gets there. That's just the way it is. Because the market makers, in which case a lot of automated market making, the algos, don't want to pay the put buyers all that money. And it's a simple thing, like my dad used to say a long, long time ago. When something gets too easy, it ain't that easy anymore. So if it's that easy to short the market and make 60, 80, 100, 200% on your money over a day, over 2 days, over 3 days, well, at some point that punch bowl's going to get taken away. And I think all of you agree with me on that. When it gets too easy to short, they just take the punch bowl away. And you get a vicious, and we've had many of those, 400, 500, 600 point reversal, 1,000 point 2-day move. And then market reverts back to its primary trend in the intermediate term that is down. I repeat again. You have to trade the charts. Use my charts as tools. Use your own gut feeling, what you want to do, and you will do okay. The other thing that many traders should do is do nothing. Seriously. When the markets are this volatile, do nothing. Sit back. Wait for some real deep oversold conditions where things are almost a high probability long trade. How about that? I've shown many of those situations repeatedly. You guys know that? So do nothing, or whatever you do small. On a scale, I am doing much more smaller trades and not going hog wild, and I put pedal to the metal on these big intraday reversals and then take them out as we move along. Today alone, we had a very powerful reversal where we went from 945 right there. Remember, charts don't lie. Traders do. Humans do. Humans are born liars, if you ask me in my opinion. Everybody overall likes to lie, whether it be white lies or black lies or half truths or whatever. Everybody likes to lie in order to fulfill their own emotional whatever, whether it be in trading and in life. And they say, well, I kind of lied because I didn't want to hurt the other person. Okay, friggin' good, but you're still a liar. So traders lie, okay? That's the way it is. Charts don't. So if you look at the chart, you got, at 945, we moved up powerful. Guess what we did? We covered the gap, the Friday's closing gap, right there. That's why I wrote gap fill. And I didn't write these things prior to it happening. I did it before. So if you were at least trading for a couple of hours, or you bought something on the reversal, as we alerted, because I alert off my charts, not off my head. The little demons in my head, I have them locked up. Unlike many of your demons who are running free amok like monkeys on crack, MOC. I like to keep my demons in my head locked. Okay? So when I'm putting out my whatever signals that I'm seeing, external as in the charts or internal as in the indicators, I'm putting them out, and even mentioning this is an intraday trade or a swing trade, whatever the case may be. So from 945 to closing the gap here, Friday's closing gap, we went up a lot. We almost went even. I think we went green at one point. I can't remember. Or we were down only 20 points or something on the Dow from being down 300 and some change. And that was at 260. That's a long move. Even if you caught half of it, you made up not only, you made enough money for the day, if not for a couple of days. Fact, not fiction. Then we kind of moved around here. Looks like the market wanted to go higher. But then came the sell program. We shorted around this level. We shorted here. Once this level broke, we actually started shorting around here. I'm sorry. So once you broke the low of the day, panic selling ensued. And the calls that I produced, the 257, 258 puts, right? Not to mention the ones that we had from Friday. Those we sold for very, very nice profits. 100+% or close to it. Or more. I can't remember all the percentage in my head. Go to my Twitter feed to see that. So then I went lower on the things because we were at 257. So I said, okay, 258. We shorted around 258.40, somewhere around here. $1.37, $1.95. They both closed at well above 90% up on this leg of the move. Then I said sell those and roll over to cheaper strikes just in case we get another leg down. So I believe that I put out there that we should buy into, roll over and buy into the 252 puts. I'm sorry. Sell the 257, 258. That was 5 hours ago. I'm reading off my Twitter feed. You guys can read too. I'm sure you guys read. Right there. Right there. Bingo. Okay, 90% plus. Close to 100% actually. Roll over to December 19th with 2 days to go. 254 puts just in case. Just in case. Though at 230. My gut tells me I might not make any money on those, but that doesn't matter. Made money on the others. In other words, my gut tells me I am not going to see it go up 100%, but who knows? Because we are in an emotional capitulation stage. You guys are absolutely terrified. Mom and pop is just in the bunker so deep they're not seeing daylight. They don't want to hear about a stock. They don't want to look at their mutual fund statement. You say stock market, they're like, yikes. And the same mom and pop were losing their heads buying the market in January. So, strategically, active traders can make a decent sum of money. You do have to be quick. This is not mom and pop's market. This is not grandpa's market. I must admit that the moves are extremely fast, but can be done. Swing traders have to buy a little, wait to see if the turn comes. If it doesn't, they can either sell out for some losses, which I wouldn't recommend, but hey, it's up to you. What do you want to do? And wait to buy at some major support levels, which in simple terms is 2018 lows, which we almost kissed today. We did kiss today. 2018 lows. Lo and behold. We have extreme oversold conditions, but in an emotionally driven market, capitulation, ETFs selling out like crazy because mom and pop are selling anything to do with stocks, their growth funds, like it's going out of, like the United States of America is going out of business. It's always the case. Been doing this for a while now. Saw the same thing happen with my clients back in different corrections, back in the late 1990s. Even 1998, during the Asian crisis, during 2000, during 2001, during 2002, when the market bottomed short-term, Enron crisis, saw the same thing happen in 2007. I'm sorry, 2008, 2009. Always at the bottom, people just sell the crap out of everything. That's what's going on. We have the highest cash level in the last 10, 15 years. Highest cash level. Nobody believes in America and its growth anymore. It's a beauty. Okay. So let's talk about technicals here. Bottom line is, let me start off with a longer term chart. This is a monthly chart, guys, monthly. Remember, this monthly chart I've shown a few times. And by the way, as a very strong reminder to all my beloved members, I am putting down more precision, short, analytical comments. Bear with me one second. Comments and technical comments on my posts to help everyone understand things better. Okay? So I highly suggest you look at my Twitter post on a real-time basis so you have an understanding of what is going on. The worst thing is not knowing what is going on. So this is the same, this chart I've shown, this is the one, okay, which I wanted to explain. So this is a weekly chart, weekly. That's the longer term monthly chart. All right, I'll go back to it in a second. This is the weekly chart, and technically this is what I see. Remember, extreme oversold conditions can remain extreme oversold for a couple of days or a day or so before they have a huge bounce that gets sold anyway. If the short-term primary trend is down. At this point, none of us are disbelieving that the short-term primary trend is down. You can see that very clearly from these charts that I produced for you guys on a real-time basis in the middle of this hectic market. So I did a day count. Day counts are very important. Day one starts here. 2, 3, 4, 5, 6, 7. I'm sorry. Day one starts the day after the big drop. And that was back on, this is a weekly chart. So I'm looking at a weekly count. So this was the week of February 5th. And trust me, these patterns are quite similar. Yes, there was slippage today beyond this pattern, lower. But the patterns are very similar. The reaction and the emotional fear and terror of the investor and the retail trader is exactly the same as what happened here. More so now because of the speed, which is a little bit faster than what happened back in February. But there was similar volatility. Trust me. I dealt with you guys. I've been in the market, obviously. So I know. So to start off the day count from the second week count actually. So the week of the 12th. So 1, 2, 3, 4, 5, 6, 7, 8. On the 8th week, 8 is a very, very powerful number. Okay? It's dead serious. Not kidding. I've seen that happen a lot in the markets. 8 days, 8 weeks, 8 months. So this was for week number 1, 2, 3, 4, 5, 6, 7, 8. Market turned on the 8th week and then had a 2-week rally, came back, didn't almost retest, but came back hard, did a reversal bounce. But if you look back overall, the market had a pretty powerful rally for 1, 2, sorry, that was 8 week. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks overall in a row. 10 weeks is a long time, guys, right? So I did a quick count. Not that it's going to be perfect, but a lot of these times when I've shown these things, they've worked out like magic. This was the big drop, the first really big drop, right? That was back on October 22nd, the week of the October 22nd. The week count starts the following week. 1, 2, 3, 4, 5, 6, 7, 8. This is this week, the 8th week. The 8th week is a very pivotal week, not because it's Christmas, not because it's a fun, joyous holiday season. It's because of a few things that's happening. What's the biggest thing that's happening? The Fed FOMC interest rate meeting on Wednesday. Second big thing, this whole budget ceiling, government shutdown threat by my good old buddy Donald from New York City is getting kind of stale. Whether the government, but he's sticking to it. Fine, appreciate his principles. Stick to it on the border wall funding. A lot of talks going on, this and that, but that unnerves the market. This is the umpteenth time that he has threatened to shut down the government over some sort of funding issue. So that's another worry. Okay? Politics aside. Whether the government shuts down for 1 day or 2 days, it always leads up to anxiety. On top of that, it's a weak market. So you go figure. That's the second thing. The third thing is the China trade deal, ongoing trade stuff that's going on. Peter Navarro was on today. I put out some comments out there. He was overall pretty constructive, even though he is a deadly China hater and hawk or Chinese business principles and stuff. But he was pretty moderate. It's good. So that was fine. In fact, the market rallied right after that, before the forced margin selling came in. So you got that, the China trade stuff. You have a very important speech about to begin now in China. Premier Xi is their economic forum that they have every year. I forget the name for it. I'll put out that article. I think I did that earlier too. It's starting now. So the comments made on that as to the future course of the Chinese economy, policies they'll implement, of course they're going to talk in broad terms, is going to be looked on by the markets very carefully. If it's a constructive speech, somewhat conciliatory towards the U.S. trade war, the war with the U.S. trade stuff, you know what I'm talking about, the market's going to take it well. So that's happening now. So those are the three things, as far as I can see, which are basically going to determine how the market will fare this week and going into Christmas and the end of the month. There's a lot of tax loss selling. I don't know what tax loss selling, because most of the market's down. So what are you selling to cover, what profits? That's what tax loss selling is all about. So saying all that, the main things are the China speech tonight, the Fed FOMC, extremely critical. That's number one. The budget shutdown impasse, which I believe they have to come to a agreement, in the House by Friday, right? And of course you have that emotional momentum selling that passive ETFs, exchange traded funds, have to do, because mom and pop selling the crap out of everything they own, which has anything to do with the word S, which is stocks. So that's it. Those are the main worries, right? So saying all that, from a contrarian standpoint, we are at some viciously extreme readings on both oversold conditions, cash levels at the highest levels, and as I'll show you in the next chart, we are reaching levels on the monthly S&P 500, which are coming close to 2009 lows. Do you guys even remember what the S&P 500 was on March 9, 2009 when we bottomed? Well, let me enlighten you, because I was on Wall Street at that time. It was the devil's number, close to it, 666, 667. Some of my biggest clients panicked, especially retail clients, because we used to do institutional and retail, and sold out of stuff that they just couldn't take the pain anymore. What happened to the market since March 9th of 2009? Up a gazillion%. Individual stocks went through the roof. And we had periodic corrections along the way as we moved up to the highs of 2018. And now we have a correction. It's not rocket science, guys. So let's talk to figure out what might go. If I draw this parallel channel on the weekly, I come to a number somewhere around 2480. 2480. So you're talking about we closed around 2547 on the S&P 500. This is your lows for the year, which was established on the 5th of February. If we hit lows for the year, it's not like we automatically bounce from there. Yeah, we'll have a small bounce, but given the ferocity of the selling and the depression, the panic, anxiety that many of you are going through, it will bounce a little bit, then it's going to break that. It's going to break that. That's my opinion. Okay? And good for anybody who is a somewhat smart trader, because we want the cheapest possible prices to really hunker into, bite into. So the lower it goes, the better it is, as long as you have some cash on the side. If you do not have cash on the side, you're done. Okay, so if you want to rob grandma or take your doggy's retirement fund, I suggest you do that. Put that cash on the side of it. Have some cash on the side. So if we slip and slide after these intraday tactical bounces, which we take very good advantage of, as you know, through my diligent work that I produce every single day, I show you what's going to happen 15 minutes, what's going to happen 1 hour, whether the gaps are getting filled, whether we're going to fall, right? And then it happens. So you have to react to it. Some people say, I'm so busy, I can't react to it. Well, I say, well, I'm sorry, I can't help you. All right, can't help you. I'm doing my job. You got to figure out how to do your job. So bottom line is, if we fall, slip and slide fall, we can come down to a low. You can see that clearly from this chart. And remember, we are still in the 8th week, right? This 8th week does not end till Friday. We could slip and slide all the way to 2450. So if we drop from 2550 to 2450, they are talking about another 600 or 700 points. Let's take the higher number, another 700 points. You don't think we can drop another 700 points? We can do that in 1 hour. We did that. We do it intraday almost every other day. 700 points down, 400 points up, 600 points down. Intermediate term trend change down. Extremely oversold. Doesn't matter. You can stay oversold for a bunch of days before it turns. Just the way it is. Just the way you can stay overbought for months and months, which many of you did not even make any real money on, which is a tragedy, to be honest with you. You guys know what I'm talking about. Which reminds me of one thing, which all of you should write down straight through your head. It is as difficult to trade a rising, powerful bull market as it is to trade a downward sloping bear market, in which particular case, wide swings. Look at the enhanced volatility here. Very similar to what happened here, but these are 600-700 points up and down. Even this blood red candle was up first before it went down. So they're equally difficult to trade, if not more, than and the bull and the rising markets are equally difficult to trade. Look, I don't bullshit. I trace facts, okay? Sometimes people don't like the facts that I mention. Who the heck cares? But the fact is that even in a rising market, I'm talking the short-term 2018 rising market, okay? I'm not talking about since 2009. How come so many of you, and I'm just talking my members, but overall traders, did not make shitloads of money? I mean, crap loads of money when the trend was going higher. Because it is very hard, a fast momentum market moving on the upside. And of course, it's certainly hard on extreme volatility markets, which are sliding to the downside. They're equal. Just the way this is a white swan event. In other words, they're flying higher. White swan, I'm going to say WS. This is a black swan. So black swans and white swans, believe it or not, are equally difficult for a trader. Once you accept that truth, you shall be set free. Trust me when I tell you that. Okay, think about it for a minute. Even in a rising market, I saw what my traders did. They were missing out on every single big trade or making very little on the upside movement. Just the way they're missing out significant portions of intraday movements and the overall downside trade. Which I must admit, I'm just playing it mostly intraday and overnight and not going from here to here with a very large short positions. I admit that. At least I accept. Is it my fault? Absolutely not. Because I've made more money on tactical trading on the upside than I have on the downside, especially at these extreme levels. Some people say, I knew the market was going to go down. I told you so 3 months ago. I say, hogwash, take a walk. Don't bullshit me right here. Okay? Nobody knew. Nobody knew we were going to drop this fast, this quick, so quickly. And the only people who knew, nobody knew for to start with. The only people who can claim credit are the ones who basically missed out on every single upside move. And remember, this is 2018 we're talking about. Okay? Every single upside move, and then came back to brag when things fell on a three-week basis or a 2-week basis. Okay? So, like they say in New York, never bullshit a bullshitter. All right? So, let's move on. Nobody knew that we would fall this fast, this quick. Saying all that, let's look to see what we can do here. So at this point, we are approaching, give or take, 60, 70, 100 points from touching the lows. And I believe we did touch the lows, and I'm not sure why it's not showing here. Now it's showing. My apologies. Oh, because I was looking at the weekly. We never touched the weekly lows. We touched the daily lows of 25.30. But when I switch it to weekly, yes, we did. We did. My apologies. The chart wasn't adjusted because I was looking at investing.com. So we did touch the 2018 lows. Okay. I knew we had because we had touched around 25.30. So if we slip and slide, go up a little bit, there's a lot of margin selling left, guys. Okay. So there's still downside left on the weekly charts. Futures are up 12 right now. They'll probably pop up. I don't know what the Chinese speech is going on. I'm going to take a look at it after I finish here. And if that's, like I said, if it's taken constructively, if it's a good, solid economic speech, not looking to inflame the trade tensions coming out of Premier Xi, then global markets are going to be somewhat relieved. So you're going to have that reflex bounce. Remember, we're playing reflex bounces and reflex pullbacks. That's what we're doing. We're playing intraday overnight pullbacks, mostly intraday on the put side, and we're playing reflex bounces intraday as well as overnight. That's what we're doing consistently. And some stocks don't give a crap about what the markets are doing, right? We know that. Few of them. NBEV, a long-term swing trade winner, has been that type of case. So saying all that, nothing more to explain here. If we slip and slide, we can drop another 600-700 points, and then we will have the inevitable bounce, which will be huge. I mean, huge. Okay, that's it. We already get huge bounces during the day anyway. We got a 350-point bounce during the day when the market almost went positive. It's up to you whether you want to take advantage or not. So that's it. I mean, please, just look at the charts yourself. This is the 8th week. Normally on the 8th week, the market turns. Let's see if that works this time. So if you want to get really aggressive and say, what's the real perfect point? You can put a lot of money in. My personal opinion is that it's mostly between the 2400 to 2440 level. This level is where you want to put the biggest, fattest bucks. And it's going to be the ugliest when you look at the screen. So don't stay over-invested. Don't put too much money at this, at these levels where we are, because we're still slipping and sliding. We're still slipping and sliding. We, like they say, we're never out of the woods, but from a technical standpoint, if we break above 2600, we have a good shot again to re-enter this wide uptrend line here over 26. What's the level here? One second. Look on the right. Look on the right here, which is 2656. 2018 break-even level is this line. You guys know that by now. Which is 2682. So if we get over 2682, or at least even get towards there, that's a lot of money. 2682 is 140 points from where we are. 140 times roughly 6. I'm taking the lower conversion. That's 840 points on the Dow. 840 points on the Dow. Can happen. It can start from here, lower, or it can start from here. But along the way, there are multiple, resistance levels, and I'm constantly showing them. Let's move on. The next one is a much bigger, longer-term picture of what's going on. Given where we are right now, I just want to mention this from a technical standpoint, guys, ladies and gentlemen, bear with me one second. Thank you for your patience. So I want to explain this chart very, very cleanly because this will give us a bigger perspective. Because when the markets get to these levels where I can see the candles in a very clean format, big fat red candles, things like that, then at least, like I said before, I couldn't really predict the long term, but I can, at this point, make a somewhat accurate technical prediction of what the downside can be on the markets and what the possible upside can be. Let's talk about the downside first. Okay? How about that? So, this was 2009. Horrific. Generational low on the market. Everyone gave up. Everyone. Including, and correct me if I'm wrong, all of you. Gave up. No one bought the lows of March and April of 2009. And if somebody did, raise your hand, tell me, and I'm going to bow to you guys. Whoever it is. Okay? None of you did. And neither did, not all of you, but nobody did out there. Not fund managers, not my clients. Some of my institutional clients did. Oh boy. That's when I made those bonuses. You don't want to even look those bonuses, back then, because I forced them as their fiduciary to buy those levels. And I knew far less about technical stuff than what I do now. Anyway, so let's take a look at 2009. 2009 was here. Where we were in the stochastics, we were here. We are here. Way up. Even after this correction. In the longer scheme of things, this is a minor correction. Minor. In the bigger scheme of things, going back to 2009. So the stochastics were down here at minus 1.0849. We're all the way up here, thousands and thousands of points higher. And the stochastics are getting to the same level as 2009. So when you zoom out and be an adult and think about it in a common sense way, the market is so frigging panicked about everything that internals and the level of selling and capitulation and panic, which results in more selling, is forcing the technical, the stochastics in this case, to reach levels not seen since 2009. Whoa! Do you guys even think what's going on? The economy is way better than what it was in 2009 at the bottom of the craziness. Interest rates are far lower than 2009. Banks are far more capitalized and in better health through every single frigging stress test that the FDIC and the Federal Reserve have put them through. The U.S. economy is humming along. President Trump and his team have cut BS regulations and onerous regulations and costs for companies, given them fat tax breaks, which have been extremely healthy for the overall U.S. economy. Job creation is moving along. Yet, markets are way higher than what they were in 2009. Yet, the internals are approaching 2009. I'm sorry, maybe I'm just like really clueless and stupid. Yeah, I am stupid, okay? I'm stupid, okay? How about that? I sound like Trump. I'm stupid, all right. Consider me stupid. But that doesn't make any sense to me. That is a massive positive divergence. Internals approaching 2009. Markets way up on a percentage basis. Yet, the internals showing the level of fear and panic approaching 2009 levels. Cash levels are the largest since 2016 right now, as in money that's moved out of stock mutual funds, ETFs and such, sitting in cash. Ron Paul comes out, good old Ron Paul, Mr. Gold Standard, says we are approaching 1929 depression levels. Why didn't somebody give Ron Paul a one-way ticket to the gulags in Siberia or somewhere? Or send him to China or North Korea? How about that? Or Iran, how about that? Because he is unbelievably the biggest fearmonger I've ever dealt with. Thank God that most people don't give a hoot what Ron Paul says. He said that this morning or over the weekend. Seriously. If you think the U.S. economy is that bad, if you believe that President Trump is doing that crappy a job, and if you think that he's not going to cut a deal with China like he did with Mexico and Canada, then why don't you get a one-way ticket and just leave? Somebody else will take your place and do a better job in helping the U.S. economy. Not that serious. But that's what happens during these times. Fear-mongers come out, and they just basically scare the living daylight, and that causes more selling. So I'll move on. All right, this is my opinion. So this is something significant. This is significant. Now, from a technical standpoint, it's still not fully oversold. So that's the drawback, right? So if you're looking for a perfect moment, that perfect moment would be somewhere where you have both the lines below 20 and you start to see a turn. Of course, you want to be in here before the turn. Now, that's on a monthly basis. So it's not something that's happening tomorrow, right? So I believe that that might occur in the month of January. It's my opinion. So if you want to put some little moolah on the side, little cash hoard, then you should be looking to put that and get ready to attack when I'm showing this chart when these things are way down here. The technicals, okay? This is, I'm putting money in your pocket, but what I'm explaining to you guys, that's serious. These are generational lows. You can make unbelievable amounts of money with smaller amounts of money and say you did it. Because the markets don't always give you these beautiful chances. I'm not talking right now, but coming up. Beautiful chances to really make tons of money off the market. And the best part is that we have a reference point. We have 2015, 2016. We have between 2011 and 12. And we have the ultimate reference point, which is 2009. The generational, multi-decade low. So now that we have those reference points, you know that you can attack and come in deep hard with some, whatever max capital you can, trading capital, investing capital, and hit the market at that point. Do I think it'll go all the way down here? What the heck do I know? I'm just showing you what I see. They're plunging, they haven't turned, and they'll plunge a little bit more. Now, that plunge could be can be contained at this level, and both the toes turn, or they can slip inside all the way down here. So if it does that on the internals, what happens to the external? What happens to the S&P 500? You're not going to get this from Kramer. You're not going to get them from the Fast Money guys or Todd Gordon and all those guys. You're getting it here at Clueless Aid Trading. And do spread the word, guys. Okay? Get some referrals. Get some real, you don't even need ballers. You can get some real traders in here. Or even fake traders who want to be real traders. How about that? All right? Because everybody is so scared. So, lower end of the Bollinger. Remember, the Bollingers are still climbing higher. The uptrend line from 2009 is very much intact. So, very simple. Very simple. The uptrend line is intact till about 2363. That is thousands of points from here. Not that thousand, but not that bad. 2363 is about 200 points from where we are, right? It's another 1,200 points in the Dow. We can get that. We can get that in the next month or so. So 2,300 is base level, uptrend line retest. That's another 1,200 to 1,500 points on the Dow Jones Industrial Average from where we are. A little bit more, maybe. So that's number one. And the bull market is still intact because every single time the market dipped, the same old Ron Pauls of the world and the same old demons in your head all came out and said, this is it. This is the big one. Well, this is the big one. This was the big one for that time. And this was the big one for that time. And this was the big one for 2010. Every correction is the big one. Okay? It's never a big one. That's why we're still alive, right? Because when the big one comes, we're gone. So, saying all that, somebody please buy a one-way ticket for Ron Paul and send him out to Korea, North Korea, or Iran, or Russia, or somewhere out there, please. By next week. Somebody's going to hear this, and I'm going to get some calls from Ron Paul's lawyer. But seriously, he's a goddamn idiot. So, anyway, saying all that, you got the lower end of the Bollinger is 2360. If you really want to be technical, we are retesting the lows of 2018. The way the heaviness of these candles, and please listen carefully, The heaviness of these candles, to me, tell me that any type of bounce, and these bounces are big, right? We've seen them, 1,200 point of bounce, will be sold. That's my opinion. Because candle dynamics tell me that just the way, there doesn't have to be any fundamental reason. It's just a pressure of selling and forced margin selling that comes out of the hedge funds. I had a stat written down here for you guys that I heard last week. In 2018, 174 hedge funds closed down. 174! And only 140 or something, or 144 were created. Normally, it's the opposite. And I believe that 174 number probably went up from last week. It's probably 180 or 90 hedge funds that are closing down. These are small to medium-sized hedge funds. Now, when they close down, what happens? They sold their holdings. Now, these hedge funds are both in the U.S., and of course, there are Asian hedge funds which are closing down. I believe this number was overall hedge funds globally, including the U.S. I apologize. There were 174 closures in third quarter alone. Third quarter. What was third quarter? July, August, September. In the months of July, August, and September, there were 174 closures of hedge funds. Lots of forced selling. Lots of forced selling. Contrarian, it's a good thing. Get the heck out of Dodge. Give us these companies at some extremely cheap prices. And let's get a generational chance to buy them at bargain basement prices. As long as the companies grow substantially. So, this is it. We are at 2018 lows. This is way oversold. We could slip and slide a little bit more, but get a substantial bounce, which in my opinion, if you know a downtrend line, we could go up to, again, we could go up to 2,700. We could even go up to 2,800. But my opinion, they will sell that. And the ultimate buys, the ultimate perfect moments, gentlemen, ladies and gentlemen, will come in at the 2,400 level. That's it. That's my long-term forecast. This is not years and years. This will all happen within the next 2 to 3 months. 1 to 3 months. How about that? What we need to see, what I need to see, and all of you need to see, is this getting deep 2009 oversold conditions, which we're not there yet. We're plunging, but we're not there yet. Now, a close-up of the same thing shows us this. This one I like. This is a close-up, zoomed in. Massive, massive. And this is not just US. This is global stuff going on. Of course, on a monthly basis, we can now study them as a reference point. A massive bearish engulfing, right? That which you're bearish engulfing, the body of this red candle is far larger than encompasses the body of this green candle. So when I look at this, my little quick common sense and the few brain cells in my head tells me there's so much selling pressure that it has to sell a little bit more. There was selling pressure here too, but look at the size of these candles versus this in the past 3 months. So net, we get down towards 2450 over the next, I don't know, we could get to 2450 in the next couple of days. If the Fed doesn't cooperate, we can go to 2450 on Wednesday. Once we get towards that 2450 level, and I have my charts drawn very nicely, this was the rising wedge breakout that occurred on, and we called it, on February of 2017. If anyone doesn't believe me, go pull up the video cast from that period, all on YouTube. You see what I was talking about. We had a massive ascending triangle breakout, first on July 1st, and then on November, a couple of months later, August, September, October, November. Looking at this chart here, this is how the lines are drawn. This is a rising wedge, and it actually broke out of it and didn't look back. So coming back and retesting the top of this rising wedge, which is around 24.25, it's okay. Technically, it's fine. Bull market's alive. Long-term bull market I'm talking about, alive. Long-term bull market dies if we break below the 2300 level and we fall into the 2200 level, because at that point we could drop all the way down here. Of course, this is a much more longer term forecast, but if the US economy really falls into a mini depression or recession for whatever reason, then we could. This is hardcore stuff. They're talking 5, 6, 7,000, 9,000 points on the Dow. We could fall all the way down here, but that doesn't happen in one day. What short term, 2450 around that level, substantial bounce, and then we see. That's your long-term forecast. So you want the perfect moments? This is it, right around here. That's the ultimate technical perfect moment. Or here. It's an 8. Wow, I didn't even want to draw an 8. It just came out like an 8. All right, short term, you just got to trade the charts. There's nothing to it. This was the cup and handle. It was following cup and handle. It was following the range. Boom, broke down. We shorted. We did well. Now it's moving higher. Futures are up about 11.5. Again, this is a short-term downtrend channel. You guys can clearly see that. Each of these ranges can be traded quite easily. I'm not going to make this difficult and say, oh, it's so difficult. It's not. You can buy a couple of SPY calls and trade these ranges. This is your range. And these ranges are wide. They are about 200 to 300 points. So now we're here. There's your downtrend. Downtrend line gets broken over 25.90. At that point, you get that move up towards 26.10. There's another. This was the original handle. Remember the original handle, right? Got to know how to read charts. This was your original handle on this large cup. This one. Upper end of the handle is 26.31. Every single thing that I draw overall gets touched, both on the downside and upside. So do what you need to do. In between this wide channel, in between this very wide channel from 26.20 to 25.40, that is 80 points times 6, around 500 points. This is a 500-point channel, this thing. It's a 500-point channel. We get 500 points like this within 2 hours, right? We know that. Within this wide channel, we have an accelerated downtrend channel, and that's this one, this red line. Now, I'm not here to tell you how active you want to be or this and that. I'm just showing you what the roadmap is. You guys do what you need to do. And I'll put in my little things about I'm buying this, I'm selling this, but I cannot, I warn you, in extremely fast volatile markets for obvious reasons, I cannot post every 5-10 minutes what I'm doing. You have to manage your own trades accordingly. So that's chart number 1. Number 2 is the same thing, the Fibonacci retracement right there. Perfect gap fill, pullback. This was a point of like mixed signals. What's going on? I'm not even showing the stochastics. I'm just showing you the externals on this. This is the 50% Fibonacci level. Still hasn't been adjusted. It's still here at 2. It's actually right now has been adjusted. My apologies. It is at 264.47. Okay, let's call it 265. Or if I want to adjust it, 264.47. Remember, some traders have better mathematical brains. You don't have to be a rocket scientist as long as you can add and do percentages. You're fine. But you can, this is the 50% retracement level, 264.47 right there. This is a 38.2% Fibonacci level. This is a 23.6. So each of these levels are where you have points of contact. Let's move on to the next chart. This is a slightly bigger swing chart. It's a 1-hour chart. This was the big sell-off that started at around 12 noon. This one, after we traded this, we went short at the 258 level, slightly above 258. I always look to see the closest strike to where I'm going to short. So it was 258.50. So I figured, okay, instead of buying the 259 puts, let me buy the 258s. As it started to slide, I said buy the 257s. And now I said buy a couple of the 254s just in case we slip and slide. Because there is so much selling pressure, right? So that's it. This is your daily. This is important. The daily is this is the daily S&P 500. These are the signs and what we call wave 5. Didn't I show wave 5? Where's the wave 5 chart? It's a Q's sample. There we go. Let's look at this chart. And I'll end this. I don't want to bore you guys too much. So, Elliott wave theory says there are 5 waves. I'm not an expert in Elliott wave theory, but you know, at times of extreme duress in the market, both on the upside when things are too, people are too happy, during times of euphoria and during times of massive distress, I believe Elliott wave works very well. Just the way Fibonacci retracement worked very well. So why are we calling this the 5th wave? Well, look, simple. Wave 1. Let's change the pen color. Sorry, guys. Wave 1, 1. Wave 2, 2. Wave 3, 3. Wave 4, 4. Wave 5. That's the wave we're in right now. Wave 5, generally speaking, just the way we had wave 5 of the euphoric stage back in January when every mom and pop wanted to buy the stock, chat rooms were full, everyone's like, oh, it's going to go to the moon. And I said, guys, be careful. And then we had a huge drop in the market. I didn't think we were going to drop that big, but that was the first signs of major enhanced volatility. But everyone was very happy. Now, we don't even have a single person in the chat room most of the days other than 1 or 2 people, which is fine with me. I get to concentrate instead of answering all kinds of questions. I get to concentrate. And feel free to come in and ask any question you'd like. I'm always monitoring that on one of my screens. But I tend to concentrate on putting out actionable charts for you guys to make money off. So that's okay. But that is behavioral finance, right? So everyone is so despair. The diaper sales are going through the roof. Okay, adult diapers primarily, and everyone's bunkerized to the point that no one wants to even talk about anything, which is good. Good signs. Good signs. So saying all that, this is wave 5. So if you look at it from a technical standpoint, where can wave 5 do? All I simply did was, and the points seem to match, which I like, points of reference here. There's your downtrend channel. It goes all the way down to the bottom, which coincides at around 2470 to 2480. We went today, and this is a minor hammer, just the way there was a minor hammer here. That's the reason why futures are up 11. So what does the minor hammer tell me? That the most we can get to, at least from a technical standpoint, is the downtrend channel retest, right? The downtrend channel, the upper end of the downtrend channel becomes massive resistance, right? Simple stuff. 1, 2, 3, 4. This one even didn't quite even make it there, which we thought it would. But the market suddenly turned at around 2,800. So, we were doing good because we made nice, decent money off this move. You guys know that? It was an overnight trade. And we do it quite often. So the market is downtrending. This is a downtrend channel. The market is downtrending within a very wide range. It's not rocket science, guys. Okay? It's not easy to manage to do very fast trades, but you can do this. You can do this. So this is what's going on. So now we didn't quite get to the bottom yet, but if we do get to the bottom, we're looking at 2440 on the E-minis, 2480, and whatever the case, if all slips and slides, then we are coming down here. And again, if we decide to move up on the opening tomorrow, then the markets will hit that massive downtrend line. And there's a fair probability, given the nervousness and the capitulation and the heavy sales of adult diapers in the market, that we're going to sell off again. Okay? So, if somebody wants a perfect moment, it would be 2440, given where we are right now. If the Fed doesn't cooperate, we're going to 2440 real fast, guys. All right? But it ain't going to happen in a straight line. But you can always hedge. They'll put a little bit in because that little bit gets a lot bigger because of the panic selling that will ensue if the Fed still remains hawkish on their statements and raises rates on Wednesday, which high probability they will. Because if they don't, like I said, the markets will rally, then fall. And we're going to short the crap out of the market. Because the Fed doesn't raise rates, that means something is very, very, very wrong. That's it. So there's your channel. So this is capitulation wave 5. Generally, wave 1 equals wave 5. So let's see where wave 1 is coming from. Are you guys ready? Yes? Are you guys ready to see wave 1?
Yep.
All right. So let me scroll down. They always say wave 1 equals wave 5. Read up on Elliott wave theory. I don't really subscribe to it that much, but I think. So if we look back at where the wave 1 came through, then, one second, one could consider, remember we said wave 1 was, this would be wave 1 right there. It is considered to be the longest wave. So wave 1, 2, 3, 4, wave 5. It's a perfect match, guys. 4, 3, 2, 1. They always say that wave 1 overall, this is wave 1 overall, everyone can see that, starting all the way back in October, equals wave 5. It's the longest wave. So if this is the longest wave of selling, this equals 1 equals 5. Elliott wave theory. So once wave 5 ends, begin a new cycle. Another 5 waves. So once wave 1 ends, the 5 waves end. 1 second. There you go. Remember, then you get a substantial rally. And starts the next wave. 1, 2, 3, 4, 5. Now, these waves lasted, wave 1 lasted from beginning of October till November, right? Look, October, right there, till the end of October. Wave 2s are short, they lasted half the month. Wave 3s are short, they lasted half the month. Then December, they lasted into, half the month. Right there. But anywhere from 10 to 15 trading days, 10 trading days or so, 2 weeks. See that right there? Look at the dates. Longest wave. How long did this last? It lasted almost a full month, 20 trading days. This started in December. 20 trading days overall ends this week. 15 trading days ends this week. Yeah. Do you see what I'm getting at? These are not perfect things, but these are things I've seen occur. They don't occur a lot. So when they occur, one needs to be cognizant about it. And I still like to believe that I still have a couple of brain cells left. So that's what I'm showing you guys. This wave is, 1 second, is encompassing 3 weeks in December, going into the holidays. This lasted 3 weeks in October. These were short waves. They lasted 2 weeks apiece. Wave 5 ends somewhere in this range. Substantial rally. Last thing I'll tell you guys. Generally speaking, you get a lot of selling that happens in January. Right? The first part of January. Tax deferred selling. They don't want to pay taxes for this year, so they basically get into taxes for next, they'll say, okay, we'll sell it in the next calendar year, so our taxes are deferred for 2019. Well, guess what? This year, most people are underwater. Most mom and pop are underwater. So what tax loss selling, tax deferred selling are they going to do? They're already doing panic diaper selling right now. So my sense from my experience working on the money management side on the street is this year we have done a significant portion of the selling, which would happen in January, already in the month of December. Does everyone follow what I just said? It's not a science, but this is a very intelligent assumption on my part. I believe we have borrowed a good portion of the selling that happens in the deferred tax selling that happens in January, and we have already done it we already done it in the month of December. And these facts, what I just said, is validated by numbers that are being shown right now, showing that the overall hedge fund, the overall mutual fund, and the pension funds are significantly underpositioned in U.S. equities, given their obligations and their quotas they normally have in how much stocks they should own. They are significantly underpositioned. So if any spark of good news comes, which in my case the China deal will get done, any type of economic data, any type of softness out of the Fed, which would be highly welcome, will cause a massive, monumental, head-ripping, multi-week rally, which I can assure you, the average retail investor, emotional investor, will totally miss again. So that's it. That's all I want to share with you guys. All right? So in the meantime, short term, do what you need to do. Trade accordingly. I have 15-minute charts, 1-hour charts. Intermediate term, I'm showing you what's going on. I will always be trying to be on top of it. Volatility, excuse my French, and excuse me for saying this, is a bitch. Okay, especially intraday volatility. We can't, there's nothing around it. There's nothing around it. It is enhanced. It is difficult. It makes us rip our heads off, hair off, like, whatever you want to rip off, and it, no one's saying it's easy. Certain individual stocks are faring very well. I think Boeing is in a very good position. And of course, special situations like NBEV, and once in a while, some of the other little ones just keep running. But it is an erratic market, and the price fluctuations are so fast. And the only way you can see where they can fall to, where you can buy them for a quick intraday trade or overnight trade, is through the charts. Because if you're just following the prices, it means nothing. Apple overall, as long as it holds that 160, 165 level, in my opinion, is going to bounce. And it has bounced. It's still bouncing. It's a fantastic way to play the market. I think Toll Brothers is pretty damn good. It's nice and quiet. Moves along, holding that nice year-to-date levels. Housing numbers are going to be coming out soon. And I think the market has priced in a terrible housing market. With interest rates coming down, last thing I'll tell you, it's pretty obvious. Refis are going to go higher, more mortgages are going to get locked in, and the lower prices in some of the higher-end homes are going to get bought. Homes which are priced at $1.2 million, $2 million, $900,000 now are 30% cheaper just in the last 3 months. New Jersey, New York are some of the highest real estate area in the world. I mean, in America at least. And the higher end has come down tremendously. So somebody looking at that $900,000 house, $1 million home, or $800,000 place now can buy it 20 to 30% cheaper. With rates lower, is that a win-win situation? As long as the U.S. economy does not fall into a recession, which I highly doubt. Oil prices have collapsed. Fill up your gas tanks. It's cheaper. All these things which are supplemental taxes on our daily lives have come down. But U.S. corporations need to basically, earnings season is going to kick in. It's going to be very, very important. If they start griping and moaning and the China effects are starting to show up, whether one likes it or not, this whole trade war with China is not doing anything good for U.S. corporations. It's not. I said this before. And if they start to say that this is hurting them, look out below. All right. On that note, have a great evening. We'll we'll gather our thoughts tomorrow. It is a very choppy market. And more importantly, the downtrend is still intact. Doesn't mean you short every single time. However, any type of quick initial reflex rallies, like I show, need to be sold for now. However, the Fed can dramatically change things. This budget ceiling shutdown garbage has to go away. The China trade and Xi's speech, whatever he's talking about tonight, is going to, could turn the fate of the markets. Aside from that, The final look, I'll tell you, is this long-term chart. The ultimate perfect buying opportunities are a couple of thousand points lower, to be honest with you, or 1,400 to 1,500 points lower. And this is where we are right now. We still haven't fully bottomed for a multi-week, multi-month rally yet. God bless you all. All right. Thanks for attending. Thank you, guys.
Thanks, Frank.
No problem, Jack.